Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
I'm Jamie.
And today, we've got a massive stack of intelligence to unpack. The mission for this deep dive is to map out the June 2026 strategic risk outlook for the UK economy. And just looking at the sources you've brought in, it is a heavy mix.
It really is.
We've got data from the Office for National Statistics, Bank of England intelligence, FCA consultation papers, and a highly provocative AI policy essay from Anthropic, plus this bombshell £28 billion dossier reported by The Telegraph.
Yeah, we are absolutely looking at what you could call a perfect storm right now.
Right.
Because you've got this rapid, frankly, terrifying technological evolution with AI, and it's crashing headfirst into geopolitical fragility. And all of this is sitting on top of a macroeconomic recovery that is completely stalled.
Stalled might be an understatement. But before we get into it, a quick note for you listening. Some of the sources we're diving into today cover some highly charged political and geopolitical topics. Government resignations, overseas conflicts, highly scrutinized executive pay.
Right, the really sensitive stuff.
Exactly. So our goal here is strictly analytical. We're impartial observers. We are just looking at the data in these documents to understand the structural realities without taking any political sides whatsoever.
Spot on. We have to follow the mechanisms, not the politics. And to understand the pressure that's building within the financial system right now, we first have to look at the immediate economic reality hitting the UK.
The macro shock.
Yeah, the macro shock. Because the anomaly here isn't just inflation. You already understand how a geopolitical conflict thousands of miles away in Iran disrupts shipping, spikes energy prices, and filters down to the domestic economy.
Yeah, we've seen that playbook before.
Exactly. But the true anomaly right now is what's happening to growth and wages in the face of a contraction.
Well, let's unpack this, because the ONS data is stark. In April 2026, UK GDP contracted by 0.1%.
First monthly fall since August 2025.
Right. And if you look at the sectoral breakdown, it gets worse. The arts, entertainment, and recreation sector dropped an astonishing 9.1% in a single month.
Wow.
The ONS attributes this directly to the ripple effects of the Iran conflict and this massive squeeze on discretionary leisure spending. People are they're pulling the plug on going out.
And that contraction is exactly why the CBI, the Confederation of British Industry, reacted so sharply. They've just downgraded UK growth to a really sluggish 1.1% for 2026.
But the employment forecast is the real shocker there, right?
It is. It alters the entire risk landscape. The CBI is forecasting a 5.5% unemployment rate by the end of the year.
Which means roughly 2 million people out of work.
2 million, yes.
And here is the paradox. Usually, when unemployment rises like that, wage demands fall. The old Phillips curve dictates that a looser labor market cools down inflation. But the Bank of England agent summary for June 2026 just completely shatters that assumption.
Oh, completely.
They're warning that wage settlements for 2027 could run 0.5 to 1.0 percentage points higher than previously expected.
Yeah, which keeps public inflation expectations climbing right back toward that 4% mark.
Exactly. It fundamentally breaks the traditional economic models. The cost of living squeeze is so severe that workers are demanding higher settlements simply to survive, regardless of the fact that 2 million people might be out of a job.
In a toxic mix, stagflation on steroids. And let's look at how that stagnation is playing out in the corporate space. Because the London Stock Exchange is experiencing what you can only call a corporate exodus.
Yeah, the sources say the LSE is getting this sort of bargain bucket reputation.
Bargain bucket is the perfect phrase. It's not just a cyclical dip anymore. Think of the UK public markets right now like a landlord who has just neglected property maintenance for a decade. The house is so undervalued that foreign buyers are swooping in to buy it just for the land value.
Right, it's an arbitrage on our macro stagnation. Look at Tate and Lyle. They've just accepted a £2.7 billion bid from their U.S. rival, Ingredient.
Which is a 59% premium on their share price.
A massive premium. And EasyJet is facing a highly opportunistic bid from Castle Lake, a U.S. private equity firm. Dollar-backed overseas buyers are just looking at the UK, seeing artificially depressed valuations, and taking our best names private or moving them abroad.
And the political and social backdrop to all of this is incredibly tense. In the dossier we're looking at, we have Chancellor Rachel Reeves stating, and I quote, "The choices I have made as Chancellor mean our economy is in a stronger position to deal with the costs of the war."
But simultaneously, we're seeing government resignations putting the Prime Minister under intense pressure.
Exactly. And juxtaposed against this brutal cost of living squeeze, you've got Nationwide CEO Debbie Crosby's £4.7 million pay packet making front-page headlines.
The optics are just volatile, but for the risk professionals listening, it creates a severe structural blind spot. And this is my main question. Looking at all this data, are UK banks currently stress testing for the wrong scenario?
It's a brilliant question.
Because if their internal models assume a standard recovery and standard wage disinflation for 2027, aren't they already driving blind? I mean, it's like a leaky bucket. Wage inflation keeps interest rates high while actual output is just draining away.
They are optimizing for a map that no longer matches the territory, and that misalignment is the core danger. But, it's not just the economic models that are failing.
Yeah.
While traditional indicators are stalling, technology is accelerating at a terrifying pace.
Which brings us to Anthropic CEO Dario Amodei's essay.
Yes, policy on the AI exponential.
This is a massive pivot from the macro economy, but it's crucial. Amodei is basically arguing that we have a catastrophic regulatory mismatch. He focuses on what he calls Mythos-class frontier models.
The really, really big ones.
Right. And he says AI has moved from being a fun productivity toy to, and this quote is wild, a country of geniuses in a data center.
A country of geniuses. It's chilling. And to understand his urgency, you have to look at the underlying mechanism, which is scaling laws.
Right.
For the past few years, the AI industry has found that if you throw exponentially more data and compute power at a model, its capabilities just increase predictably and drastically. We aren't hitting a plateau at all. And because of these scaling laws, Amodei argues these Mythos-class models now pose strategic, nation-state level cybersecurity risks.
So his proposed solution is drastic. He's calling for a regulatory framework similar to the Federal Aviation Administration, the FAA in the U.S.
Mandatory third-party auditing.
Yes. And critically, he wants the government to have the absolute power to block or reverse dangerous AI deployments. And to describe the policymakers trying to regulate this, he uses this brilliant analogy from Lord of the Rings.
The Hobbit one, yeah.
Yeah. He compares AI and our political institutions to the hobbits and Treebeard. He writes, in the several years that it can take Congress to act, AI can go from an amusing toy to the full country of geniuses.
Because the legislative machinery operates on a timescale of years, right? Committees, debates, drafting. But AI scaling laws operate on a timescale of months. The current legal infrastructure is just fundamentally incapable of matching the velocity of the tech.
I mean, I love the Lord of the Rings reference, but I do have to push back on his FAA analogy.
Go on.
It's easy to ground a Boeing airplane. The mechanism is physical. You revoke its license. It sits visibly on a tarmac. But how do you realistically ground a line of code or the digital model that lives in a cloud?
Well, that is the central friction of AI policy. But Amodei addresses it by shifting the focus away from the software onto the hardware. You can't ground the code, but you can regulate the compute thresholds. You govern the massive energy-intensive hardware supply chains. Because to train a Mythos-class model, you need tens of thousands of highly specialized microchips.
Oh, right. So if a government regulates the physical fabrication plants, they effectively ground the AI by starving it of processing power.
Exactly. Controlling the physical plumbing to limit the digital reach.
That makes a lot more sense. And speaking of regulating structural plumbing, let's shift back to the immediate reality for consumers. How are regulators trying to help ordinary people caught in this macroeconomic squeeze we just talked about?
Well, that brings us to the FCA's CP 2618 consultation paper.
Right, which closes on the 28th of July, 2026.
Correct. And the FCA is essentially attempting a comprehensive mortgage reboot. They recognize that the traditional 9-to-5 job-for-life model is practically extinct for a huge demographic.
Yeah.
And the lending rules need to reflect the modern workforce.
So the key proposals in this paper are all aimed at opening the door to borrowers who are currently being rejected by these automated algorithms. For example, they want to remove the mandatory repayment strategy requirement if the interest-only portion of a mortgage is below 25% of the property's valuation.
Which is completely logical. I mean, if a borrower has 75% equity in their home, the systemic risk to the lender is incredibly low.
Yeah, negligible.
Right. So the bank doesn't need to force the borrower into a rigid, expensive repayment plan for that final 25%. Just to satisfy a compliance checklist.
Right.
It frees up monthly cash flow for the consumer.
They're also easing the retirement interest only or RIO joint affordability stress tests for surviving spouses, which is a massive relief for older borrowers who might otherwise be forced to sell their homes when a partner dies.
Exactly.
And crucially, they are allowing quarterly or non-monthly payment schedules for gig workers whose income fluctuates seasonally.
So what the FCA is demanding here is contextual underwriting. They want banks to look at the individual borrower's actual cash flow reality, rather than letting an algorithm say no just because an Uber driver or a freelance designer doesn't have a perfectly flat monthly paycheck.
But here's where it gets really interesting, because looking through the source material, it highlights this fascinating contradiction. Since 2014, the UK mortgage industry has boasted a 99% non-arrears rate.
Which on the surface, regulators usually applaud.
Right. It sounds phenomenal, like a student getting an A+ on every single exam. But is the FCA finally saying out loud that this isn't actually a badge of honor?
That's the million-dollar question.
Because logically, a 99% success rate doesn't just mean banks are exceptionally good at risk management. It implies that banks have only been lending to the absolute safest, wealthiest kids in the class, deliberately excluding viable borrowers who just don't fit a cookie-cutter profile.
That is exactly the subtext of this consultation paper. A zero-risk lending appetite means you are structurally locking out the gig economy, the self-employed, first-time buyers who don't have massive inherited deposits. The FCA is forcing lenders to realize that maintaining a pristine 99% non-arrears rate is actually a failure of social utility.
Yeah, they want banks to accept a slightly higher but managed level of risk.
To keep the housing market functioning at all. If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
So we've talked about the FCA trying to loosen the rules to help viable borrowers at the retail level. But at the exact same time, they are dropping an absolute hammer on financial crime and regulatory failures at the executive level.
The leniency for corporate negligence is completely gone. We are seeing brutal enforcement actions. The FCA just fined Bank Trust CEO Carlos Ricardo Fornmayer £99,600.
And the core issue wasn't even a complex trading error, right?
No, it was basic disclosure. He failed to disclose U.S. investigations and frozen Venezuelan accounts to the regulator. The FCA explicitly labeled his non-disclosure as negligent.
And it doesn't stop there. The FCA has also launched civil proceedings against Neil Woodford and W4.0 FZE LLC over providing unauthorized investment advice via their platform, W4PZ.com. They're alleging breaches of Sections 19 and 21 of the FSMA.
If you are operating outside the regulatory perimeter, the grace period is over. And the regulatory crackdown is intensifying because the scale of illicit finance bleeding through the system is just mind-bending right now.
Which brings us to the Telegraph's £28 billion dossier.
Yes.
And again, just neutrally reporting the findings of this document, it maps out a horrifying vector of state-sponsored economic warfare. The dossier reveals taxpayer money inadvertently funding massive national security threats.
It's staggering.
We're talking about COVID stimulus loans ending up in the hands of ISIS terrorists, state grants going to Russian state-linked companies, and investment research funding Chinese military operations.
The mechanism here is hostile actors exploiting the very systems designed to stimulate our domestic growth. When the government pumps billions into the economy during a crisis, prioritizing speed over friction, sophisticated criminal networks use shell companies to siphon that capital.
But if we want to talk about systemic exploitation, we really have to look at the data Lloyd's Banking Group just released regarding social media fraud. Because this reveals a structural failure costing ordinary people millions.
The asymmetry here is wild.
Lloyd's revealed that 68% of all fraud reports from their retail customers originate on Meta-owned platforms, so Facebook, Instagram, WhatsApp. That asymmetry is causing £66 million in annual losses just for Lloyd's customers alone.
And we have to look at the reimbursement mechanics to understand the true asymmetry. Under current UK models, banks are reimbursing 88% of the victims of these authorized push payment or APP scams.
Where a victim is manipulated into transferring their own money.
Right. The banks are absorbing the vast majority of the financial hit.
Meanwhile, a Reuters investigation estimates that roughly 10% of Meta's 2024 revenue, which translates to about $16 billion, comes from advertising for scams and banned goods. I mean, think about the mechanics of this analogy. It's exactly like a nightclub where the bouncer is being actively paid by pickpockets to let them through the front door, but the cloakroom attendant inside is forced by law to refund everyone's stolen wallets.
That is the perfect way to describe it.
Is this the single biggest structural failure in UK finance right now?
It is arguably the most costly asymmetry in the retail sector, bar none. The banks are spending hundreds of millions on detection technology, but the social media platforms upstream are actively monetizing the very advertisements that lure the victims in.
And the vectors for this fraud are everywhere. It's not just high-tech crypto scams. The FCA is currently warning about fake Martin Lewis car finance compensation ads flooding social feeds.
Oh, those are everywhere.
And at the same time, the government is seeking new powers to double closure orders for dodgy high-street vape shops and barbers that are just acting as physical fronts for organized crime money laundering.
Which brings us to the ultimate question for the institutions. With geopolitical shocks driving inflation, the terrifying speed of AI threats, massive fraud asymmetries, and a shrinking economy, how does the actual structural plumbing of our financial system hold up?
Well, the Bank of England is not waiting around to find out. They have set a strict non-negotiable deadline of 31 March 2025. By that date, all recognized payment system operators, RPSOs, and specified service providers have to mathematically prove their operational resilience against extreme but plausible disruptions.
And the FCA is applying the exact same pressure to investment vehicles. Look at their new reforms for money market funds. They are mandating a 40% weekly liquid asset or WLA buffer for stable NAV funds.
Let's break down the mechanics of that for a second. A stable NAV fund is designed to keep its share price at exactly £1. Investors treat it as a safe alternative to cash. But if a geopolitical shock hits and a panic ensues, causing a massive wave of withdrawals, the fund might be forced to sell off underlying assets at a loss, causing the share price to drop below £1. They break the buck.
Right. So this 40% WLA buffer is essentially a regulatory shock absorber. It forces the funds to keep a massive pile of pure, highly liquid cash on hand so they can meet a sudden run on the bank without collapsing the entire fund. They're building resilience into the macro plumbing.
But we're also seeing incredibly smart structural innovation at the micro level to help consumers navigate all this. Monzo recently launched their Flex Build card. It's designed as a lifeline to people with poor or thin credit files.
Which is a growing demographic right now.
Yeah. And the mechanism is fascinating. It requires a small cash deposit to open the credit line, which mitigates Monzo's risk. But impressively, that deposit earns a 2.75% interest rate, perfectly matching their standard savings account rate. So what does this all mean for the listener?
It's a brilliant alignment of incentives. But broadly, what this means for compliance and risk professionals is that you aren't just rule followers anymore. You are the architects, keeping the engine from exploding while the car is being rebuilt at 100 miles per hour.
So true. Let's quickly recap the core takeaways from today's deep dive. First, the UK is facing a stagnant macro economy, with 2 million unemployed forecasted by year-end despite stubbornly high wage inflation.
Yep.
Second, the AI exponential is forcing a complete rethink of regulation, with leaders demanding FAA-style grounding powers over hardware compute thresholds. Third, the FCA is overhauling who gets a mortgage, moving away from a rigid zero-risk lending culture.
Towards contextual underwriting.
Right. Fourth, the regulatory enforcement against fraud and non-disclosure is brutal, exposing a multi-billion-dollar asymmetry between banks and tech platforms. And finally, the structural plumbing of the economy is undergoing immense mandatory stress testing.
And I want to leave you with a final thought to mull over. Building on Dario Amodei's AI essay, he outlines what he calls a Tier 3 scenario. This is a future where AI creates unprecedented human unemployment, but also generates massive economic abundance, funded by universal capital accounts and digital dividends.
Wait, like a universal basic income?
Essentially, yes.
Uh-huh.
And if that future arrives where human labor is no longer the primary engine of personal income, what happens to the entire foundational concept of credit scoring? How will a retail bank underwrite a mortgage application or assess a business loan when the traditional salary model simply doesn't exist anymore?
That is a staggering paradigm shift to consider.
It really is.
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp and stay compliant.